Barbara is 71 years old. She lives in Ohio. Her son James is 43 and was laid off 8 months ago. He has 2 kids in school and a mortgage he is struggling to keep current. Barbara has savings. She has a home worth $400,000 that she bought for $80,000, $30, or years ago. She has a brokerage account with stocks she has held for decades. She wants to help her son. It is her money. She earned it. She should be able to give it to her family. So she does what most parents would do. She James a check for $20,000. Then she transfers some of the appreciated stock into his name. Then, because she has heard you can give up to $19,000 a year without any tax issues, she gives another $19,000 the following year. 3 years later, Barbara falls. She is in the hospital. She needs long-term care. Her savings have depleted faster than expected. She applies for Medicaid to help cover the nursing home costs. The state looks back 5 years at every financial transaction she made. Every check, every transfer, every gift. They find the $40,000 in cash and the stock transfer. They calculate a penalty period. Barbara is disqualified from Medicaid benefits for months, possibly longer. She is in a nursing home. She cannot pay out of pocket. The money she gave to James is gone. James cannot return it. The IRS told her everything was fine. The annual gift exclusion said $19,000 per recipient was allowed. She filed no gift tax return because she owed no gift tax. Medicaid operates under a completely separate set of rules that have nothing to do with the IRS. And nobody told Barbara. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional and a licensed elder law attorney before making any decisions about your specific situation. My name is Olivia. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through the 3 specific rules the IRS and the government use that punish retirees for helping their children. I am going to explain why the $19,000 gift exclusion is one of the most misunderstood rules in retirement. I'm going to show you the capital gains trap that destroys wealth when parents give the wrong asset to their children. And I'm going to give you a clear action plan for how to help your family without triggering any of these consequences. Most of what I'm about to explain is not widely known. Your accountant may know the gift tax rules. Your financial advisor may know about capital gains, but very few people explain how these rules interact with each other and with Medicaid in a way that costs real families real money. Let me start with the rule that catches the most people by surprise. The IRS annual gift tax exclusion in 2026 is $19,000 per recipient. That means you can give up to $19,000 to any individual in a single calendar year without filing a gift tax return. A married couple can give $38,000 per recipient per year. You can give this to as many people as you want. You can give $19,000 to each of your 3 children, 7 grandchildren, and 2 neighbors and owe nothing to the IRS and file nothing. If you exceed $19,000 to a single recipient in 1 year, you file Form 709 with your tax return, but you almost certainly owe no gift tax. The lifetime gift and estate tax exemption in 2026 is $15 million per individual. That number was made permanent under the One Big Beautiful Bill Act. You would have to give away $15 million over your entire lifetime before a single dollar of gift tax is actually owed. So the IRS rule is clear and relatively generous. Give under $19,000 per person per year, and you do not even have to report it. Give more. Report it on Form 709. Reduce your lifetime exemption. Never pay $1 of actual tax unless your cumulative lifetime gifts exceed $15 million. Here's where the trap begins. Medicaid is not the IRS. Medicaid is a joint federal and state program. It has its own rules, and its rules for gifts are completely different. When you apply for Medicaid long-term care benefits, the program that covers nursing home care, home health aid services, and similar extended care, the state looks back at your financial history for the 60 months immediately before your application date, 5 years. Every gift, every transfer, every asset sold below fair market value during that 5-year window is reviewed. And this is the critical distinction that destroys families. The IRS gift tax exclusion provides zero protection under Medicaid rules. None. A gift of $500 made last year can trigger a Medicaid penalty period just as surely as a gift of $50,000. The Medicaid system does not care whether you filed a gift tax return. It does not care whether you owed any gift tax. It looks only at whether money or assets left your control during the look-back window. The penalty for gifts within the Medicaid look-back period is calculated by dividing the total amount gifted by the average daily cost of nursing home care in your state. This daily cost is called the penalty divisor, and it varies by state. In a state where the average daily nursing home cost is $350, a gift of $35,000 creates a 100-day penalty period. In a state with a higher cost, the same gift creates a shorter penalty. In a lower cost state, a longer penalty. But in every state, the math works the same way. The gift amount divided by the daily rate equals the number of days you are ineligible for Medicaid benefits. The penalty for gifts within the Medicaid look-back period is real, calculated precisely, and cannot be appealed simply because you did not know about it. The resulting number is the number of days you must wait before Medicaid will pay your bills. During that penalty period, you are expected to pay for care out of pocket. If you have already spent down your assets trying to qualify for Medicaid and you have no money left and the penalty period is still running, you are in a deeply serious situation, and the penalty period does not begin until the day you are otherwise eligible for Medicaid. Hi, I am Olivia, and you are watching American Dream Route. The clock does not start on the day you gave the gift. It starts the day you apply after spending down your assets. So the worst case is that you have given away money, spent down everything else, applied for Medicaid, and only then does the penalty period begin. This is not a theoretical risk. Long-term care is the largest unplanned expense in retirement, and it is one that most retirees do not plan for until it is already happening. According to the Department of Health and Human Services, about 70% of people turning 65 today will need some form of long-term care during their lifetime. More than 40% will spend time in a nursing home. The median annual cost of a private room in a nursing home in the United States crossed $100,000. Medicare pays for skilled nursing care after a hospital stay for up to 100 days under very specific conditions. After day 100, Medicare stops for most retirees who need extended care beyond what Medicare covers. Medicaid is the only program available, and Medicaid is the program that reviews every gift you gave in the last 5 years. Let me walk you through 3 people so you can see exactly how this plays out. Dorothy is 68. She gives her daughter $5,000 every Christmas. She has done this for 4 years. She never files a gift tax return because the amounts are under the annual exclusion. She assumes everything is fine with the IRS, so it must be fine with Medicaid. At 72, Dorothy has a stroke. She needs nursing home care. She applies for Medicaid. The state reviews 5 years of bank statements. They find $20,000 in Christmas gifts spread over 4 years. All of it is within the Medicaid look-back window. The state calculates a penalty period based on the total transferred. Dorothy is denied Medicaid coverage for a period of months because of gifts she gave to her own daughter from her own money within the annual IRS limit. Nobody told Dorothy the IRS limit and the Medicaid limit are 2 separate systems with no connection to each other. Robert is 70. He has a house worth $350,000. He bought it in 1990 for $60,000. His son, Michael, is going through a divorce and needs housing. Robert decides to deed the house to Michael to help him out. He is not selling it. He's giving it to his son. 2 years later, Robert has a health crisis. He applies for Medicaid. The house transfer within the 5-year look-back is flagged. The state values the transfer at $350,000, the fair market value at the time of transfer. The penalty period calculated from that amount is severe. Robert is ineligible for Medicaid for an extended period. He has no house, he has limited savings, he is waiting for a penalty period to end while incurring nursing home costs he cannot cover. Robert also handed his son a tax problem he did not intend to create. Michael now owns a house with a cost basis of $60,000, the price Robert paid in 1990. When Michael eventually sells that house, he will owe capital gains tax on the difference between $60,000 and whatever the house sells for. If it sells for $350,000, Michael owes tax on $290,000 in capital gains. If Robert had simply kept the house and left it to Michael through his estate, Michael would have received a stepped-up basis equal to the fair market value at the date of Robert's death. Michael could have sold the house the next day and owed nothing in capital gains. Robert gave his son a $350,000 house and a significant capital gains tax bill. He intended to give him a gift. He created a liability. Linda is 73. She has a brokerage account containing stock she purchased years ago for $20,000. The stock is now worth $90,000. Her daughter is starting a small business and needs capital. Linda transfers the stock to her daughter to help. Linda's gift is within the annual exclusion for the year. No gift tax, no Form 709 required. But Linda's daughter now owns stock with a cost basis of $20,000. When the daughter sells it to fund the business, she owes capital gains tax on $70,000 of appreciation. At the 15% long-term capital gains rate, that is $10,500 in tax on what was supposed to be a tax-free gift from a parent. If Linda had simply sold the stock herself and given her daughter the cash, Linda might owe tax on the same gain. But Linda's income and bracket matter here. If Linda is in a lower income bracket and her long-term capital gains rate is 0%, which applies to single filers with taxable income up to $47,025 in 2026, she could have sold the stock herself, paid zero capital gains tax, and given her daughter $90,000 in cash with no embedded tax liability. Same asset, same intention, entirely different tax outcome depending on who sells. The long-term capital gains rates in 2026 are 0%, 15%, and 20% depending on income. For a single filer, the 0% rate applies to taxable income up to $47,025. For a married couple filing jointly, it applies to income up to $94,050. Many retirees in their early retirement years before Social Security and required minimum distributions begin are in this 0% bracket. They have a window where they can sell appreciated assets themselves, pay zero federal capital gains tax, and then give the proceeds to family as cash. This is one of the most powerful and underused strategies in retirement. It eliminates the embedded gain. It eliminates the carryover basis problem for the recipient, and if done in years before the Medicaid look-back window is a concern, it can be structured to minimize that risk as well. The window is narrow. It requires knowing your income in the year of the sale. But for retirees who have it available, it can be worth tens of thousands of dollars compared to simply transferring the appreciated asset directly. If this video is showing you traps your family has never discussed, hit the like button right now and share this with anyone you know who's thinking about giving money or property to their children. They need to see this before they act. Subscribe and turn on the bell so you never miss a video like this one. If what you just heard about Medicaid and the look-back window is something your family has never discussed, hit the like button right now. This is exactly the kind of information that needs to reach people before they make a decision they cannot undo. Subscribe and turn on the bell. I publish every week, and the next video covers another version of this trap. Now, let me explain the stepped-up basis rule in full, because it is one of the most valuable protections available to retirees, and it disappears completely the moment you give an appreciated asset away during your lifetime. When you die and leave an appreciated asset to your heirs through your estate, the cost basis of that asset resets to its fair market value on the date of your death. This is called the step-up in basis. Under IRC Section 1014, confirmed and intact in 2026 under the One Big Beautiful Bill Act, your heirs inherit the asset at its current value, not what you paid for it decades ago. The practical effect is enormous. If you bought stock for $20,000 40 years ago and it is worth $300,000 today, and you leave it to your child, at death, your child's cost basis in that stock is $300,000. If your child sells it for $300,000 the week after you pass, they owe zero capital gains tax. The $280,000 in appreciation that built up during your lifetime simply disappears for tax purposes at the moment of inheritance. Now consider what happens if instead of leaving that stock to your child at death, you give it to them as a gift today. Your child receives the stock with your original cost basis of $20,000. If they sell it for $300,000, they owe capital gains tax on $280,000. At a 15% federal rate on long-term gains, that is $42,000 in federal capital gains tax. At 20% for higher earners, it is $56,000 plus state taxes in most states. You gave your child a gift worth $300,000. You also gave them a tax bill worth tens of thousands of dollars. They may not even realize it until they try to sell. The rule is simple and it matters enormously for planning. Never gift a highly appreciated asset during your lifetime if you can leave it through your estate instead. The step up in basis at death eliminates the built-in gain entirely. No tax, zero. The gift during your lifetime preserves that entire gain and transfers it to your child as a future tax liability. There are situations where gifting makes sense. If the asset has not appreciated significantly, the basis issue is minimal. If you are making annual gifts of cash, there is no basis concern at all. If your estate is large enough that estate tax is a consideration at the $15 million threshold, gifting can reduce the taxable estate. But for most retirees with appreciated stock, appreciated property, or long-held investments, the step up in basis at death is worth more than any lifetime gift strategy. Here is your action checklist. 5 specific steps based on where you stand right now. One More Trap deserves its own moment because it affects retirees who are trying to help their children using their IRA accounts. When a retiree takes a distribution from a traditional IRA and then gives the cash to a child, 2 things happen. First, the full distribution is ordinary income to the retiree in the year it is withdrawn. If you pull $60,000 out of your IRA and give it to your child, you owe income tax on $60,000 at your rate. The child owes nothing on receiving the cash gift, but you paid the tax to fund it. Second, that $60,000 withdrawal may push your modified adjusted gross income over the RMAA threshold for Medicare, triggering higher premiums 2 years later. It may make more of your Social Security taxable, and it is still a transfer that Medicaid will review if it occurred within the 5-year look-back window. Retirees who fund large gifts to children by taking IRA distributions are paying income tax on the transfer, potentially triggering Medicare surcharges, and still creating a Medicaid look-back issue. They think they are being responsible by using their own money. They do not realize that the funding source adds a tax layer on top of the gifting consequences. The better approach in many cases is to give cash from a taxable brokerage account or savings where the withdrawal itself does not create a new tax event, rather than funding gifts from distributions that are fully taxable as ordinary income. Step 1. If you're currently making annual gifts to children or grandchildren, verify that those gifts are not creating a Medicaid look-back issue. If you have any possibility of needing long-term care within the next 5 years and at 65 or older, most people do. Talk to an elder law attorney before making any more gifts. The 5-year Medicaid look-back window is running whether you know about it or not. Step 2, never gift an appreciated asset to a child or grandchild during your lifetime if you can leave it through your estate instead. This includes stock held in brokerage accounts, real estate, business interests, and collectibles. Calculate the embedded gain before you decide to gift. Subtract your original cost from the current fair market value. That difference is the tax your recipient will eventually owe if you give it now instead of leaving it at death. In most cases, the step up in basis makes waiting far more valuable than giving. Step 3, if you want to help a child with a large expense such as education or medical care, the IRS provides 2 unlimited exclusions that Medicaid does not penalize in the same way. Direct tuition payments made directly to a qualifying educational institution are excluded from gift tax entirely with no dollar limit. Direct medical payments made directly to a healthcare provider for someone's medical expenses are excluded from gift tax with no dollar limit. These payments bypass the annual exclusion entirely and are not transfers of assets in the same way that cash gifts are. Talk to an elder law attorney about how your state treats these payments under Medicaid rules before assuming they are fully protected. Step 4. If your estate is below the $15 million federal estate tax exemption in 2026, and for most retirees it is, the urgency to reduce your estate through lifetime gifting is low. The step up in basis benefit of holding appreciated assets until death is likely worth more than any estate tax savings from giving those assets away. Now, this calculation changes significantly if your state has a state-level estate tax with a lower threshold. Several states have estate tax exemptions well below $15 million. Know your state's rules before assuming you have no estate tax exposure. Step 5. If you have already made gifts within the past 5 years and you are approaching an age where long-term care might become necessary, consult an elder law attorney immediately. A Medicaid asset protection trust or other planning tools may help mitigate exposure. But these strategies require time to implement and typically require assets to be in a qualifying structure for 5 years before they are protected. The sooner you act, the more options you have. Here is the villain in this story. It is not the IRS. The IRS gift tax rules are relatively generous. The annual $19,000 exclusion is real. The $15 million lifetime exemption is real. The step up in basis at death is one of the most valuable provisions in the entire tax code for middle-class families with appreciated assets. Before I get to the villain, let me address the question I know is coming in the comments. Can you get the gifts back? In most cases, no. A gift is a completed transfer. Once you give money or property to another person, you have no legal right to demand it back. If your child used the money to pay down debt, invested it, or spent it, there's nothing to return. In the Medicaid context, the state may ask that the recipient return the gifted amount to cure the transfer. If the money still exists and the child is willing and able to return it, the penalty may be reduced or eliminated. But if the money is gone, or the child refuses, or the property has been sold, the options are very limited. This is why timing matters so much. The 5-year Medicaid look-back window means that gifts given more than 5 years before a Medicaid application are generally not counted. If you're healthy and you're planning to give gifts to family, doing it earlier rather than later keeps those transfers outside the look-back window by the time you might need care. But this requires planning at 60 or 65, not at 73 when a health event has already occurred. A Medicaid Asset Protection Trust, sometimes called a MAPT, is a legal tool that some families use to move assets outside of Medicaid's reach. Assets placed in a properly structured, irrevocable trust are generally not counted for Medicaid eligibility purposes, but only if the trust was created and funded more than 5 years before the Medicaid application. The 5-year clock on the trust runs from the date of funding, just like the look back on direct gifts. This is not a strategy you can implement after a health crisis. It is a strategy that requires setting it up years in advance. The villain is the assumption that the IRS rules are the only rules that apply to giving money and property to family. They are not. Medicaid operates under a completely separate framework. Capital gains tax operates under a completely separate framework. State-to-state taxes operate under a completely separate framework. And almost none of these rules are explained together in a single conversation before a retiree makes a decision they cannot reverse. Barbara gave her son $40,000 and some appreciated stock because she wanted to help him. She broke no IRS rule. She owed no gift tax. She filed nothing wrong. She is in a nursing home with a Medicaid penalty period running because she did not know about a 60-month look-back rule in a program she had never thought about. Dorothy gave her daughter $5,000 at Christmas for 4 years. The IRS would call it insignificant. Medicaid called it a transfer within the look-back window. Robert gave his son a house he meant to give him security. He gave him a carryover basis that turned into a capital gains tax bill and triggered a Medicaid penalty that left Robert with nothing. These are not wealthy families making sophisticated mistakes. These are ordinary retirees doing ordinary things with money they earned and saved and intended to share with people they love. The rules that penalize them are real, enforced, and almost never explained in advance. This is American Dream Route. If this video showed you something your family needs to know before anyone gives away any money or property, share it right now. The decision to give is irreversible in most cases. The knowledge needs to come first. Tell me in the comments, has your family ever made a gift and later found out it had a consequence nobody expected? I read every single one, and the most common situations become future videos. Subscribe American Dream Route for more latest updates.